Why would you save money when they're printing money?
Everybody's printing money now.
Why would you save money when they're printing money?
I know you don't save money. You're building businesses.
Why would you save money when they're printing money? You see, if you cannot think, I cannot help you. I questioned all that. Why would I save money when they print money? That's what happened in 1971 when President Nixon took the dollar off the gold standard.
The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
It's nothing to do with communism or capitalism. It's the banks run the world. The rich run the world. They don't care if you're communist or capitalist. So when you save, so let's say you save $1 US or €1, 1 yen, the banking system can lend out 10. So the entire system is called the fractional reserve system. The fractional reserve system is also printing money. And then they tell you to save money. So they want you to save money so they can lend out your money 10 times.
There is no money made by saving today. How many of you know about compound interest? You're like, compound interest is the holy grail. No, not today it isn't. There is no compound if you're making 0.04% at the bank. Today's Friday's average savings rate in America was 0.12%. That ain't 12%, that's 0.12%. That's not 1.2%. That's 0.12 of 1%. It'd take you 80 years to make 10% of your money.
Well, cash is always a bad investment. I mean, when people said cash is king a year ago, I mean, that's crazy. I mean, cash wasn't producing anything, and it was sure to go down in value over time. And then you always want to be sure you have enough. I mean, it's like oxygen. You want to be sure it's around, you know, but you don't need to have excessive amounts of it around.
Cash is the least safe investment. It just doesn't have the same volatility to it because they're producing so much cash. It has a negative real return. It's a tax that maybe 2% a year you lose money in terms of cash.
I made a reference to Pablo Escobar. He didn't know how to convert the bag. Cash became his cash by itself is garbage. Okay, the rats will eat it. The mold will get it. It's just going to go away. It's being depreciated every second of every day. The greatest tax in the world is inflation. It's a hidden tax. So it goes down in value, right? They just print more. So its ability to buy things goes down in value because the price of things goes up.
So all I'm saying to you is if a person does not question what they've been taught, they will always be poor. They've been hypnotized into being poor. So that's why you don't save money, is because your money is becoming worth less and less and less and less and less. The banks are getting richer and richer and richer.
Now, where's my money?
So what do you do?
So what you have to do is...
You want me to speak? We're not pointing you yet.
You have to have a well-diversified portfolio. And first of all, you have to be...
Coming at it from an investor standpoint, you look at the 440 or 450 self-made billionaires in the world, the largest category of them is not real estate, it's not gold, it's not oil, it's not sports, it's not media, it's not the food industry or hotels or fashion. What makes the most billionaires, without a doubt, about 77 is investors. It's double the nearest category, other category, more than tech. It's not Mark Zuckerberg's that are dominating the Forbes list. It's still investors. So the first rule, if you're writing this down or keeping mental notes, is no matter what you do, come at it from the standpoint of investor. So once you understand that, then the second point is,
you can't wait till you have a ton of money to start investing. If you can invest in business, even a small amount, you can grow. And I don't care how small it is, but you got to automate it. You got to take a percentage of what you earn and pretend it's a tax. You're never going to see that money again. You automate it, it goes straight to the investment account, and you never see it as money you can spend. When you save 20% and you compound it, its numbers are incredible. So, but then the problem is, if you do that first step, but you don't do the second step, which is become an insider.
Yes.
And understand the rules of the game. I'll give you 2 or 3 of the myths real fast. One, this myth that someone says, give me your money and I'm going to beat the market. Over any 10-year period of time, 96% of mutual funds will not even match the market. They've all said it. Warren Buffett flat out said today, he said, listen, in my will, 90% of my money, all that money does not go with any mutual fund, it goes straight into the index.
You know, I made it public. On my death, there's a fund for my then widow, and 90% will go into an S&P 500 index fund, and 10% of Treasury bills.
What the index is you get a piece of all the largest companies in the world, but it costs almost nothing to get in. You hire someone because you say, I have a family, I have a business, I have a life. I'm not an investor. I'm going to hire someone who's a professional. It makes sense. They would do better than me. Unfortunately, that's wrong. 4% of them will beat the market. 4% chance to find the right mutual fund. It's not going to happen. So the second thing is, after getting terrible performance, people say, well, fees don't really matter, or they'll tell you it's only 1%. Forbes says the average fee is 3.12. Now, 1% versus 3%, big difference.
Huge.
Right? Here's the difference. Just like you grow by compounding, your fees also compound. If you had 3 people and one gets 1% in fees, 2%, the other in 3%, they all get the same return. They start out with $100,000 at 35. For 30 years, they accumulate to 65 years old, 7% compounded. They all get 7%. And when they go to retire, the person had 1% in fees is going to have $574,000. The person at 3% in fees will have $224,000. 77% less money. You could own the stock market, the S&P 500. You can own a piece of all 500 big companies through like the Vanguard 500. Mm-hmm. And you get the best of all the business, Apple, Exxon, all these companies. And it costs you 0.17. If you went to a normal mutual fund, you might own the same companies for 3.17. That's like buying a Honda Accord for $20,000 or $350,000 for the same car. That happens every day with finances because people don't know how to look at this. All I want to get you to know is the game is you got to tap the power. Step number 1. Step number 1, if you repetitive, I want you to get it. We want to make that decision right now. Step number 1 is make the most important financial decision of your life. Decide right now, what percentage are you going to keep for your family forever? What percentage of your money are you going to set aside, automate, and make sure you put in a freedom fund that you're going to start to invest and build into something that will eventually provide that income for you where you never have to work again as long as you live. You only work because you want to, not because you have to.